Hi, Assalamualaikum. My name is Nurul Hanis binti Nur Hadi. I'm from JBA1144H. Today I will show the types of risk investing in common stock. Before we start, let me be honest with you. Investing in the common stock is very risky. If you think that investing in stocks is as safe as cash or bank deposit, then you are completely wrong. Although historically speaking, stock market investment has given the best return compared to gold, bond funds or other options. However, the return from the market is not guaranteed and you may even lose your entire money in stocks. Now, I'm not trying to scare you, but I'm just highlighting the fact over 90% population lose money in the stock market. Why? Because they do not understand the different types of risk involved in the stocks. A beginner who starts swimming knows that it's dangerous if he goes in the deep water before proper training. He knows that he might even get drowned in the water. However, when it comes to stock market, people just ignore the different types of risk involved and ready to dive in immediately. Nevertheless, if you know the risk, the chances are that you can mitigate it. At least you have a backup plan. That's why in this post I'm going to explain 7 types of risk involved in the stocks that you should know. So let's start. About the business risk. The business risk can be escalated if the business is not doing well. Reasons like the failure of management, poor quarter-by-quarter results, or your misjudgment in picking a company come under business risk. Market risk. Market risk is also called systematic risk and is based on the day-to-day price fluctuation in the market. The market index Sensex and Nifty goes up and down throughout the day, and many a time it may affect the returns from a stock. For example, if the market is going down at a time, then it might be pulled down the price or even some good stocks. Moreover, in the short term, market risks are higher compared to the long term. Interest rate risk. The open market or global market interest rate changes time to time, and this can positively or adversely affect the stock market depending on the direction in which the interest rate is moving. For example, when the interest rate is high, a company might find it difficult to borrow money at higher rates. Further, the bond market declines as the interest rate increases, which may also affect the corporate bonds. Last but not least, liquidity risk. Before investing in a stock, you should definitely check how solvent the company is. Companies with high debt may find it hard to pay their bills. Many times, they might even cut the dividends, or in the worst case, may go bankrupt. Liquidity risks are involved in all businesses. Before we end, there are a few other risks that worth mentioning. First, social and political risk. Many companies face problems due to social and political risk. For example, Tata Motors shifted its Tata Nano plant from West Bengal to Sanand, Gujarat because of political reasons, which cost a lot of money to Tata. Second, credit risk. The risk that the company who issued the bond won't be able to pay the interest or to repay the principal at maturity and may find it hard to buy or sell goods. Number 3, FII or DII investment. The investment by big players can also be counted as the risk involved in the stock. If the foreign direct investment or domestic investment decreases in a company and they start selling their stocks, then it might adversely affect the share price of that company. And the last one is currency and exchange rate risk. Many companies who deal across nations or the companies involved in import-export may face a problem with increased dollar price. Therefore, the currency and exchange rate fluctuations might increase risk in these companies. I really hope that the input in this video will help you a lot to determine and differentiate between the types of risk in investing in common stocks. And with that, I thank you.